let's take our first look at cost, volume, profit analysis. First of all, we're going to look at our costs and break them down in a little different way now. We're going to look at fixed costs versus variable costs. Then we're going to look at volume. How many units do we have to sell of each item in order to break even? And then we're going to look at profit. How much of each item do we have to sell to hit a certain target operating income? For example, if we make $10 on every product that we sell, in other words, if each product contributes $10 towards the bottom line, and our fixed costs are $100, we'll have to sell 10 units to break even. And that's all there is to cost, volume, profit analysis.
Cost, volume, profit analysis sounds complicated, but it is not rocket science.
Cost, volume, profit analysis does sound complicated, but it's really pretty straightforward. Remember our income statement: gross sales minus our dissatisfied customers minus the customers that pay us early give us our net sales. And that's the number we're going to look at going forward here. Minus the cost of goods sold. So if we buy a bottle of bleach from Clorox for 90 cents, put it on our shelf and sell it for $1, our sales are $1 and our cost of goods sold is 90 cents. That gives us our gross profit of 10 cents, or our markup, if you will. Then we subtract our SG&A to give us our operating income, and from that we subtract interest expense and taxes to give us net income. Cost, volume, profit analysis is another way to look at our costs that allows us to help management make good decisions about what we should sell our products for, and how many of our products we have to sell to break even, and how many of our products we have to sell in order to get a certain target operating income. So let's focus on the heart of our income statement here. Sales minus cost of goods sold gives us gross profit, minus SG&A gives us operating income. Let's break those costs down a little differently into fixed costs and variable costs. So for purposes of cost, volume, profit analysis, we're going to say sales minus variable costs gives us contribution margin, minus fixed costs gives us operating income. And what do we mean by fixed costs and variable costs? A fixed cost is a cost that does not vary in proportion to sales volume. So I have an airline and I book straight line depreciation on my airplanes. The more passenger miles I fly, the more sales I have. It doesn't affect my depreciation. It might change. I might buy a plane or I might sell a plane, but it doesn't change in proportion to my sales volume. On the other hand, a variable cost does change in proportion to sales volume. Think about fuel for my airline. The more passenger miles I fly, the more sales I have. The more sales I have, the more my fuel cost goes up. There's also a thing called a mixed cost. So for example, I may pay the Oakland Airport a certain annual sum to use their airport, and then every time I dock at one of their gates, I pay a docking fee. That would be a mixed cost. As you can see, there is no place for mixed costs in our new formulation. So if it isn't obvious what the fixed portion is and the mixed portion and the variable portion is of a mixed cost, we'll artificially break it down using the high-low method. There are other ways to do it, but we're going to start with the simplest way, which is to use the high-low method to make an estimate of how much of these mixed costs is fixed and how much is variable. Okay, so once we figure out what our fixed costs are and our variable costs are, what do we do with that information? Let's walk through a super simple example. Let's say I have Russ's Wine Shop where my only cost is $100 per month of rent. So whether I sell 1 bottle of wine or 1,000 bottles of wine, my rent is $100 a month. That's a fixed cost. Then let's pretend that every bottle of wine I sell for 20 bucks. Every bottle of wine costs me 10 bucks. So I have 10 bucks profit or contribution margin on each sale. So my unit contribution margin is $10. If I make $10 on every bottle, how many bottles do I have to sell to break even? Hopefully you figured that out pretty quickly. I must sell 10 bottles. 10 times $10 profit per bottle gives me my $100 that I need to break even. So you just deduced the most important formula in cost, volume, profit analysis. Fixed costs divided by unit contribution margin gives me my break even in units. I like to remember that the fixed costs are in dollars, the unit contribution margin is in dollars, the dollar signs cancel each other out, so my answer is in units. So I need to sell 10 bottles of wine to break even. Now suppose I don't want that volume expressed in units, but in dollars. What I'll do is change these numbers to be percentages. So my sales is 100%, my cost in this example is 50%, and my unit contribution margin ratio, or my contribution margin ratio in general for that matter, is 50%. So I'll do the same kind of thing. I'll take fixed costs and divide it by the contribution margin ratio of 50% to give me a break even expressed in dollars of $200. Same answer, 10 bottles of wine times $20 a bottle sale price is $200. So I got the same break even answer, one way expressed in units, one way expressed in dollars. Did we go into business to break even? No, we went into business to make operating income. So if we want to figure out how many units we have to sell to hit that target operating income, simply add that number to the numerator. If we want to know our dollars, our volume in dollars to hit that target operating income, simply add that to the numerator in that formula. And margin of safety is how far can my sales drop before I just break even. So if I told you my shop was currently doing $300 a month in sales, you would know that my margin of safety was 100. My sales are currently 300. It could drop down to 200, which is a drop of $100, and I'd still be breaking even. And that's all there is to cost volume profit analysis.